What does it take to get your financial house organized? I think now is the perfect opportunity to think about this. All the transitioning that's been going on, all the volatility in the markets, now's a great time to create some clarity within your financial plan. And in this video today, I'm going to talk about 4 simple areas that you can address to start working through that process of creating some clarity around what's going on with your money and your finances. We're going to talk about understanding your resources as the first step. We're going to talk about the potential of your investments. We're going to talk about managing risk across your financial plan. And then lastly, we're going to talk about tying up loose ends within that financial plan. A lot of great information here today, so stick with me throughout the course of the video. Of course, we're going to start off with understanding your resources. What I'm talking about here is understanding your income, right? So how much you're earning, saving, investing, spending, those are your resources, and we need to understand all the details around what's coming into the household, what's going out, right? So more often we call this cash flow. If I was creating a new financial plan, this is where I would start. I would start by understanding these resources, understanding cash flow on a really granular level. And I would start here, looking at your income, okay? Great starting point is revisiting salaries. So how much money do you make? What's your gross salary? What's your spouse's gross salary? Add that up. We need to know that. So you both make $150,000 a year, $300,000 in salary. Next thing is I would pull out a tax return and I would start looking at some of the numbers on there. What's your adjusted gross income? This number might be a little bit different from what you've added your salaries up to be if you're making pre-tax contributions to your retirement plan, because that directly reduces your adjusted gross income, okay? So those numbers might be a little different, but they're both important to know. So AGI gives us a good idea here. Now, how much of that is going to be taxed? So after AGI, we need to talk about taxable income. And that means we also need to touch on any deductions and credits that may apply within your situation. So are you itemizing expenses on your tax returns? Are there any credits that apply? So if we said your AGI was $270, maybe you've got $35,000 in itemized expenses, interest, taxes, charitable giving, right? Those sort of things. So that brings your actual taxable income down to $235,000. That's how much then we're going to apply the progressive tax schedule to that amount of income and come up with the amount of tax that you owe. It's important to know both these numbers, and I would love for you to see exactly the dollar amount of how much tax you pay on an annual basis. You'd be surprised how many families don't know this information. And it's important as we kind of dig into this and try to get organized and build clarity around your finances. Now, so the dollar amount of tax to be paid is important, but we also want to break it out and understand what our tax bracket is. So if you're, 235 is your taxable income, you're probably in the 24% tax bracket. Hey, but that doesn't mean you pay 24% tax on all of your income. It's a progressive schedule. So maybe your effective tax rate is, 17, 18%. I don't know. It just depends. But that's easy enough to find. And how you do that is you divide your tax paid by the amount of your taxable income. And that gives you your effective tax rate across your federal return. You may want to look for deductions, right? So the biggest deduction opportunities typically are pre-tax retirement contributions, and you've got state and local taxes, you've got interest expense on a mortgage, you've got charitable contributions. Those are some of the big ones for most families. If you own a business, there's different expenses you can run through there. So dig into that work a little bit as well and just try to understand, your resources as well as the tax footprint that exists within your situation. As I mentioned, it's quite common for families not to know most of these numbers, okay? So now's a great time to get a handle on that. This stuff will help you move forward in a positive way. Next, I want to talk about how much we're saving, investing, and where it's going. So how much are you contributing to savings accounts? How much are you contributing to retirement plans? How much are you contributing to taxable investment accounts? What are you putting money in any other sort of investments or long-term plays that are going to build wealth on your balance sheet for the future? I want to know those dollar amounts, and then I want to know what percentage that amounts to on your gross income. So if you're saving $30,000 a year, and I know you made $300,000 from those 2 salaries, that's a 10% savings rate. Okay, that's pretty good. We'd like to ratchet that up if we can, right? Get as close to 15, 20, 25%. I mean, that's a big number, but if you can get there, it's only going to benefit you in the long run. I'm not big on budgeting, but I am big on understanding exactly where your resources are going, how much money you're spending, how much money you're saving, and then how that's going to translate into the future. So that's the next step. You need to take a picture of what the current amount of your investments are, so what your current account values are, how much you're planning to contribute, and run the present value calculation. So if you're 20 years away from retirement, you've got 500 grand in savings, you're contributing 30 grand a year. What do those numbers look like in 20 years? That's what we need to know so you can start building a picture of, am I on track? What is this going to translate to for me in the future? Once you get all this information, it'll be really interesting for you to see, look, I paid X dollars in tax. That translates to 25% of my income overall between federal, state, and local taxes. I'm saving 20% of my income. So, add those two numbers up, that's 45% of our total gross income. That means I'm spending 55% of it. And then you can start getting more granular there too, if you want to, and see exactly where your spending is going. So as I mentioned, I'm not big on budgeting, but I am big on establishing priorities. Okay, so if you know what the amount that you need in the future is, how much you need to save, that's where I want you to prioritize. And then you can spend on the things that you enjoy the most. Okay, a few last considerations on understanding your resources, and then we'll pivot to investments. The last thing here is really tax diversification. So we're talking about this more and more because it's very important, right? So which buckets are your resources going to? So we're talking pre-tax or traditional retirement accounts, Roth retirement accounts, and then just a taxable investment bucket. Each one of those carry a little different tax structure, and they all have their own advantages and disadvantages. So it really depends on your situation, what the right mix is here. But the point is to be thinking about creating some diversification in there, because there is some unpredictability when it comes to tax rates in the future. A lot of people think taxes are low now, they're on sale, they'll probably go higher in the future. We don't know that for sure, right? Nobody really knows. And you also need to take in consideration what your current tax situation looks like. Are you in a high tax bracket? You gotta balance these things together, okay? So understanding how those numbers work, how they all play together, and then you can start formulating that plan on, hey, I'm gonna direct 30% of my savings towards pre-tax, 30% towards Roth, and then I want to start building my taxable bucket. Those are the kind of things that you want to be thinking about. That was a mouthful from understanding your resources, but I really think that's the most important part about starting to get organized. Now, the second part, also important, especially in light of everything that's going on now, understanding what the potential of your investments are. And importantly, are you allocated the right way? Are you in a suitable investment mix? Suitable is kind of one of those words that we use as investment professionals. What it means is, are you in the right mix? So let's start by this. How is your money invested? Why do you own those investments? When did you purchase those investments? When was the last time you made any changes? You got to start answering some of these questions so you can really understand how your money's invested, how it's working for you, and then establishing why you're invested before we actually build up to, is this, the right mix? What type of accounts do you have? What sort of institutions are you working with? Do you leverage a certified financial planner? What return potential do you have? How much risk are you taking? These are all questions that we want to be answering. And when we're talking about creating the right investment mix or the right structure, you got to be thinking about things like your risk tolerance, okay? And risk tolerance is important. Sometimes we need to take more risk than maybe we feel comfortable with, but it really depends on a couple other things. Your time horizon, of course, your future goals, your needs for income. Those things all work together to determine, how much money you should have in each one of the buckets between stock, equity type investments, fixed income, or those more conservative bond or cash type of investments. Right now, this is a big issue that we're seeing with a lot of the transition, especially in the federal workforce. We're seeing a lot of would-be retirees heavily exposed to stocks, okay? And it could be right for some of their situations, depending on what their needs for income are. But if you've got 90% of your portfolio wrapped up in equities and you're planning on taking income from it in the next 2 to 3 years, you're probably exposed, right? There's probably a lot of risk that you're taking that you may not be realizing it. And it's okay. This happened for a number of reasons. The two biggest ones are fixed income and cash. It's been a tough place to invest over the last 10 years. We know what interest rates have been very low. Then they increased significantly in a very short amount of time. Just made it a really tough environment to invest in bonds or hold cash. And then secondly, the stock market's been great over that period of time, right? There's been some disruptions, but overall, the market has returned really well. So we've gotten comfortable there. That doesn't mean that the risk isn't real. You need to consider it with equities, especially if your time horizon is getting shorter. If you're a long-term investor, probably the best thing that you can do, stay invested, start contributing, right? Contribute as much as you can while time is on your side. Of course, this is general guidance for information, educational purposes only. Any advice, you need to consult a professional that can help you with your unique situation, okay? All right, next we want to talk about managing risk across your financial plan. We're specifically talking about insurance here. And taking inventory of your insurance coverages can be tedious, but it is important. So a couple things come into play here. We need to understand how much life, long-term care, disability, how much of those coverages you have in place, what the details are on those policies, as well as your home, auto, umbrella policies, survivor benefits, all those sort of things. We just want to take an inventory of kind of add it up, how much coverage exists, how much you're paying for each one of those, so you understand completely where you have coverage and where you don't. And then you also want to understand what your needs for insurance are. This is a little easier from a life insurance standpoint. When you're talking about assessing how much coverage you may need, you could look at it from this standpoint. What unfunded goals do you have? What liabilities or debts do you have? Mortgage, college expenses, how much income replacement do you need for, spouse, children, anyone that relies on you? So those considerations. And then, bring into play how much current resources you have, right? And do the math between those. There's also different types of policies, whether you have a group policy through your employer, whether you have a term policy, or you have some sort of permanent coverage that you purchased on the open market. So they all work a little bit differently, and understanding the details there is important around getting organized, okay? And making sure that you have coverage where you need it so that the people that rely on you, will have what they need if the worst case scenario happens, okay? So I won't elaborate too much on the insurance aspect of it, but really what I would stress here is take inventory and determine how much coverage you have, seek out what the premiums are, and then start to work through how much coverage you actually feel you need from that perspective. And then you can start evaluating options from there and digging more into the details. All right, and the last part on this, wrapping up loose ends. So we've talked a lot about understanding your resources, very important. The investment strategy is very important. We're talking about insurance coverage or, the risk management aspect of it. So those things are all foundational pieces of a financial plan. There's also the estate planning angle, which gets overlooked a lot. Okay, so a lot of folks, families don't have documents in place, which can be easier to get in place than you might think, as well as just improper beneficiaries named. They haven't been updated when they should have been, or no one's named on a policy. Those sort of things are often overlooked, and they can be important to tie up. So take a look at your estate planning documents, what you have in place and what you may need, and don't be intimidated by that. Other common loose ends or missed opportunities, umbrella liability coverage, I think is a big one we see that folks don't have in place. If you're responsible for an accident or one of your family members are responsible and there's significant damages that come out of that, this umbrella liability policy can protect you. That's another one that's a little bit overlooked. The tax planning angle, of course, we talked about that and understanding your resources, but looking for opportunities to reduce or limit your tax liability can be really important. Understanding credits and deductions. And then, of course, figuring out your tax diversification plan. So where you're directing your resources. I think that's another really big opportunity right now. That honestly, a lot of would-be retirees, people that are really close, and wish they maybe had considered a little bit earlier. But there's still opportunities there to work on that situation. I hope you found this useful. There's a bunch of information in here. I know we focused on the understanding your resources because I think that is kind of the foundational piece. And then, the investments obviously are super important as well, because that's kind of the fuel that powers our ability to get from point A to point B when we're talking about achieving those goals. And that would be really ultimately the last thing that I would say before we wrap this up. Revisit your goals and talk about them with your partner, loved ones, anyone that's important within your financial plan so that you get on the same page. You're all working towards the same goals. Remember, if you don't have a plan, you're part of someone else's, okay? So I hope you found some value here. If you have, give us a like and a subscribe. And if you have questions, you're working on anything, we'd love to hear from you. Use this as a resource, and we'll see you next time.